Hey YouTube, welcome back to another video. This is Marco Trades and welcome to my channel. Today we're going to go over January 3rd or Friday's price action. I want to let you guys know how I got into my trade. I want to start off by saying I'm not a financial advisor. If you need financial advice, go to your financial advisor or whoever does that stuff for you. I'm showing you my Top Step eval account. I finished the week off with about $734. Or this says 733.54, but this says 734, so I don't really know what's up with that. This is the target goal. I'm on a $250,000 account with Apex funding, and just gonna show you how I would have traded yesterday's price action. So the first thing I like to do is I like to mark out my 12 a.m. price or the new day opening price on my charts. This helps me get a better idea of where price is going, because I'm not sure if you guys know, but if price is like above the 12 a.m. opening price and also above the 8:30 opening price, like those are going to be the best shorting opportunities, because the reason why we mark out these is because price likes to refer back to those price likes to refer back to that price. Okay, the market likes to refer back to that price at that time. So if you look, bullish refers back to this price. I mean, you can also look at it as this was a fair value gap, but if you were taking a shorting opportunity, because this would have been, no, this isn't London yet. But if you were looking for a shorting opportunity, for example, boom, fair value gap, 12 a.m. opening price, you can aim for that as a target. There's also this low here and that fair value gap. But anyway, I just feel like I'm nitpicky. Okay. And then the other thing I like to do is I like to mark out my 8:30 opening price. If you guys are like loyal subscribers, then you'll know that I have yet to added the 8:30 preset. So what I do is I just mark it out, and then I change it from saying 9:30 to 8:30. But I'm just gonna, I'm just gonna fix it right now, because I'm gonna be doing this every time like I do a video. I'm gonna just show you guys how I mark out my charts. So there you go. All right, so 8:30 opening price marked out. Let's see. The next thing that I do, just one sec. The next thing that I do is I wait for market to open, and then I like to see the direction that market kind of like wants to run in. I'm also gonna mark out the time frame between 10 o'clock to 11:30, because if you watch my video, as you know, those are the times when I'm looking for my trade. So like a 10. You don't have to do this, right? This isn't important. It's just better for like my eyesight, so I can better see. I'm gonna need some editing software. Yeah, so I can better see what's going on in the market. Let's see. Okay, cool. So that time frame is marked out. So let's look. We're gonna go back 9:30. What happens? We have this little liquidity sweep. Once the market opens, we wick down, then immediately head to the upside. You can look at it like this. I'll draw it out too. And this is why I'm telling you guys that fair value gaps are so important. Look at that. Look at that. I mean, this is a fair value gap too, but this is a more prominent one. But so we see that market rises the upside. So when market does that, there are going to be newbies who are going to say, oh, we're bullish for the day, just look at the price action, it's going up. Okay, we might be bullish on the day, but when are you going to get into your trade? Some people are going to say they're going to get in at the 9:30 opening. Here's why I would never encourage you to get in on a 9:30 opening. That's because if you look at the volatility, like it looks all fine and dandy when I'm showing you or when I'm back testing. When you look at the actual price action that's going on when the market opens, it's very and highly volatile. These are huge wicks, and it's easy to get wicked out. And you don't have the type of capital to hold a trade on that level. You feel me? Unless you're downsizing like all the way. But even then, like, it's still not a smart trade. It's easy to get wicked out of your position. All right. So, like, for example, this is a fair value gap. When I see this, I'm not gonna put my stop below here. My stop's probably gonna go below this low. And you see this wick down into this fair value gap. But this is what the market's kind of like designed to do. It's designed to take you out of your trade because it knows that people are gonna put their stop at a low right here. Wick down into the fair value gap, rise up. You're already out the trade. So we got this marked out. Now we're gonna mark out the highs and lows. And I hope I'm being clear. And if I'm not, like I always say, guys, comment, let me know, and I will work on that for you because I want you guys to succeed. I want to succeed. And the only way that we do succeed is if everyone's clear. Okay, so let's see. All right, so we're gonna mark out the buy sides. Let me show buy side. So we got a buy side here. Buy side at this level. And this is also the major buy side, but I'll mark out this buy side too. We don't just mark out buy side, we also mark out sell side. So let's see. Okay, so for sell side, I'm gonna mark out these relatively equal lows. And this is on the 15-minute chart. Pay attention. Time frames are very important. You have to know which time frames you want to work with. I used to work with the 1 hour and the daily, and I still kind of use it for reference sometimes, but I'm starting to realize more and more it's like, because I'm on such a low time frame, I don't really need like the daily time frame as much. So I tend to lean towards more looking at the hour, what's happening on, time is fractal, so they're all doing the same thing essentially. But I look at the hour. I don't like the 30-minute. So I look at the hour, look at the 15-minute, I look at the 5-minute, and I look at the 1 minute. And there are sometimes that I do look at the 3-minute, just depending on how the candles are forming. If they're forming in a way that's not clear, for me on the 1 minute, I tend to look at like the 3 or the 5 minute, so I can get like the like a better, more like a better view of like what's going on in price. It's more clear. Instead of all of those little candles forming, I get like one big candle, or like that. So sell side, these are all relatively equal lows, so this is actually perfect. So you could, like, for example, Monday, or not Monday, but next week, you can probably look for some sort of shorting opportunity right around this level. And then I'll put like, I have a major buy side, I don't have a major sell side. We're not focusing on these levels anyway, so I'm not gonna really pay much attention to this, but I just want to mark it out to show you guys how you mark out your levels of liquidity. And like I said, market goes from a level of liquidity to inefficiency. Okay, so if you guys didn't know, this is like, for example, this is an inefficiency. So the market goes to these levels, as you can see here. These are liquidity. This is liquidity. And liquidity is just where the resting orders are in the market. So for example, if you're taking a short, let's look at this right here. If you're taking a short, this is a fair value gap. All right, so you might be short off this fair value gap. You're profitable to this level. The market's gonna want to take you out. What did it do? It hit your stop loss. You're out of the market. Maybe you got in off this inversion right here, right? Market took you out. Maybe you got in on this fair value gap right here. You're profitable all the way here. Market took you out. So like, that's when we're saying that market likes to go towards like liquidity or inefficiencies. Like, that's all that we're really saying. Okay, so now that we have these areas marked out, I marked these out at 9:30. I just want to see like all the areas. So once the price starts moving, I know where it's going. So at this point, I know we're taking out buy side. I'm going to try and keep the video short too. At this point, I know we're taking out buy side. So I'm already framing in my mind that I want to look for shorting opportunities. Okay, so we have 9:30 open, price runs up, we're going for buy side. We took out this level of buy side. Eventually we took out this, but like I said, this is the start of when I'm looking for my trades. So I'm looking for shorting opportunities after 10. Or I'm gonna zoom in so you guys can get a better look. Okay, 10 o'clock happens, we're still going up. This is fair value gap here. Am I looking for a trade? No. And I'm gonna keep it real with you guys. It's easy to see this and think that this is a continuation move. Why? This is a bearish fair value gap. Okay, price goes down. It takes out this level of liquidity. This is also a fair value gap, so it wicks down into that fair value gap. So you can mark that out. And this is just how I do it. I like to nitpick and look at these little things because this helps me track like where the market's going, and it helps me get a better idea of how to place my trade. So you might see this here and say, okay, this is an inversion because price went down and we came all the way back up in. It makes this fair value gap, taps back in. You might be long off this area. And to be honest, if you're analyzing it like that, it's not exactly a bad idea. I understand it, but you need to wait for more confluences sometimes. Sometimes it's good to wait for the market to just give you a little bit more information before you try to get in, if you understand what I'm saying, right? So you're not wrong. Well, I mean, you are wrong because you would have got stopped out, but in your analysis of this, it's right. You just have to sometimes let the market give you more, okay? So as we can see, this happened. We took out this level of liquidity right here, and we passed back through this fair value gap from this level. So this is already telling you, okay, we're really not, and I'm going to show you where I got in and where I made money. It's showing you, okay, we don't want to go higher because we passed back through this fair value gap. Whenever you see the market makes a fair value gap like this, right, and runs back through it like this is called like an inversion. Your mind should tell you, okay, if we inversed this fair value gap, this is probably meaning we're going to go higher, right? And also, your mind should also tell you, if we inverse it again, this can probably mean that we may go lower. So you have to think like that. I wish I could word it better for you guys, but this is just how I think in my mind. You have to think like that though. So this is what I mean, wait for more information. As soon as it inverses it, some people like to enter a trade. If that's what you want to do you. I don't like to enter a trade as soon as we have this inversion, not unless I'm completely 100% sure and it aligns with my bias, which this does not align with my bias. My bias is short. I'm looking for shorting opportunities, right? So let's say I'm the average trader, which I am. I see this inversion. I'm in off here. Boom, I'm stopped out. We inverse this again. So now I'm thinking, okay, we're looking for shorting opportunities. Price displaced, taking out this low. So we have this change in state of delivery. However, this is not really a prominent low. This is more so a prominent low, and these are also equal lows right there too. So I would wait more. I would want more confluence. What I would ideally want is for price to come into this fair value gap. The consequent encroachment, at least I'll draw it out for you guys. The consequent encroachment of this fair value gap, stay below it. And for those who are new, consequent encroachment just means below the 50%. If it stays below the 50%, I'm confident. If it goes above or wicks above the 50%, and I'm not so confident. It doesn't mean a change in direction. It just means, okay, I'm a bit iffy. I need more information. So, and also, if price doesn't fill the fair value gap at all, it's a good sign because it's more like, okay, we're really bearish. We're going to rush to whichever is the nearest level of liquidity. As you can see, we didn't even go back into this fair value gap. We rushed down and we have this wick here below these lows. So that's that change in state of delivery that was more prominent. We wicked back up. But as you can see, we filled in that wick. So I'm still looking, still thinking, okay, how am I going to get into the market? If you look here, there are no fair value gaps at this level. There's a fair value gap here. There's a fair value gap here. But once price changes all the way to go back up into this level, this is not something that I like to see. Some people can be profitable on it. Not me. It's not what I like. And as you can see, once price comes all the way back up here, it completely reverses and goes to the upside. So what am I looking for? I'm looking for this change in state of delivery. I'm looking for sort of a gap. Now this is the tiniest gap that you can ever find. A gap nonetheless. So what I saw we took out this level. I also saw that this was a level of equal lows as well as this fair value gap, and this would have been the fair value gap that we tapped in at market open. So I'm thinking, okay, maybe we take out this low. I'm also thinking maybe we take out the lows that I had marked out. Did we? No, we didn't, because we were essentially bullish on the day. However, I'm not trying to be in it for the long haul. ICT, as he says you have to look for the low-hanging fruit in the market. The reason because of that is because if you're being greedy, if you let greed control you, then you can't be profitable if you let greed control you, because you're always chasing, and chances are you're going to lose more than you're going to win. So I look for this tiniest gap in the market. I see that price came in here, and then we wicked back down a little. Now, here's my thing. I did not enter in off this candle. What I did, and what I like to do, because like they say, candles are gaps in, not candles, wicks are gaps in price. So what I like to do is I like to see how price reacts once it goes back into the wick. If price fills the wick in, then I'm like, okay, we're probably going higher. If price just wicks there and comes back down like this, and it starts to form as if it's going down, it's kind of, for me, it's kind of like what I like to see to kind of get into the market and give me a sure opportunity to win. So what I did do is I waited for this action to happen. When we started going back down, I'm just going to mark it out so you can see like how profitable it was. Short position. I'm just going to put it here because this would have been where I would take it. Now, it says 48. I only used 40 ticks, just letting you guys know. So this would have been a little bit lower than this. And then my target, boom, these lows here. Really, ideally, it's the top of this fair value gap. And these lows, I wouldn't want to aim for anything lower than this, just because this is a fair value gap, price can just go in there and reverse as it did, as you guys see it doing. Now, if price completely ran through this, I would have still been able to trade, but if price completely ran through this, closed below this, and started making structure, then it's like, okay, maybe we're going lower. But one thing that you should keep in mind is if you're in a trade and there's a fair value gap, especially like an older one, like look at all these, you need to have these levels marked out, because a lot of times they'll show you like what's going to happen in price. Like for example, if it stayed above the consequent encroachment of this bullish fair value gap and like started going higher, I would have exited trade, or at least put my stop loss in profit to prevent me from losing. All right, but as you can see, what happened here is we just ran through this stop loss right here. So, not stop loss, we ran through this fair value gap right here, so that made me a bit more confident in the trade. And then we got to this level. This is where I would have exited the market. So from here to here is where it would have been profitable. As you can see, 185 ticks, only risking 40 ticks. Like I said, don't mind that. My stop loss would have been lower or just above this wick. And that's just how I would have done that. As you can see, we also continued higher, but the bias is true in saying that at 10 o'clock, there's going to be a retracement move. See, price is bullish, retracement. This happens, I'd say about 7 times out of 10, this is going to happen in the market. This is why I wait for 10 o'clock. This is why I wait for some sort of structure to the downside. So I'm just going to explain it a bit more clearly and see if I can give it a clear-cut way. Okay, market opens at 9:30. You wake up, you mark out your 12 a.m. time, you mark out your 8:30 time, right? The reason why you mark out these times is because market refers back to these times at later points. Also, I want to just point out to you guys, what's this? 8:30, right? It didn't completely touch it, but it was off by a few ticks. Just saying. Just saying. And then, well, technically, if you look at the whole candle for 8:30, like if we put this at the top of the candle, then, you know, well, that's the midpoint of that candle. But you see what I'm saying, right? So after we have our 12 a.m. and our 8:30 time marked out, we let market does what it's gonna do. If market starts going down, then I'm thinking, okay, at 10 a.m. there's gonna be a reversal to the upside. If market starts going up, okay, at 10 a.m. there's probably gonna be a reversal to the downside. We let the first 30 minutes play out. So this is 9:30. The first 30 minutes we let this play out, whatever. We see that it took out buy side. We're expecting and waiting on a reversal. If the reversal doesn't happen, you don't have to get in the trade. If anything that you want to see or anticipate seeing doesn't happen, I don't recommend getting the trade because you're already off your game because it's not what you want to see. Okay? So we let structure happen to the downside, inversion fair value gap from this level right here, displacement, huge displacement below these lows showing very bearish signs, small fair value gap here. We filled the fair value gap. We were in off this level and low. I like to get in off fair value gaps, especially when they stay below consequent encroachments. All right, so that's how I traded Friday, 3rd of Jan 2025. That's going to be my model for the year. Placing trades at 10, looking for reversals in the market around 10, and I'm looking for low resistance liquidity days. If you guys have any questions about today's video, feel free to drop a comment. Also, like the video, guys, if you enjoyed, if you learned something, and share with your friends if you have any friends that are interested in learning this content. Once again, thank you guys for joining. Thank you for being a part of the journey, and I wish you all the best in these markets. Have a great day.